Hey, are you confused about the difference between hard money and private money? Because I know you're not alone. I was always confused. I didn't know the difference between hard money and private money until, well, a couple years ago. So in this video, what I want to do is I just want to break down the key differences between these two types of lending, and I want to help you understand which one's right for you, your real estate investments, and your financial future for that matter. So if you watch to the end of this video, I'm going to talk about the pros and cons of each approach and how each one is unique and could be very unique for your specific situation. So let's talk a little bit about the source of funds. So hard money loans, where do they get their money? Well, a hard money loan is typically funded by either a hedge fund, it could be a company, a private finance company. I mean, usually hard money loans are usually Wall Street or institutional loans, but they can be individuals that pool together their money. That's rare in this day and age, but most of the money in hard money loans comes from Wall Street, of course. It's usually hedge funds or institutions of some sort. Private money lenders are typically people just like me and you. They're usually individuals. They could be lending from a trust. Maybe they're lending from a self-directed IRA or some type of a pension plan. Or maybe they're lending from what you hear me talk about all the time, an infinite banking policy. It's just like it sounds. Private money loans are private people. They're private individuals. Let's talk about the purpose of these two different types of loans. So let's start with hard money loans. Hard money loans can be used for a lot of things, but they're typically used for short-term financing. Short-term defined by like 12, maybe 24 months. That could be flipping houses. A lot of people use hard money loans for bridging the gap while they wait for traditional mortgages. For example, if you got this great deal and you're going to get this house, but you got to get a mortgage for it. Mortgages take a while with banks. So you need the money to close. So what you do is you do gap funding. A hard money lender will lend you the money for a specific period of time, and then when the traditional loan comes in, you pay the hard money lender back. So private money, they can be used for a variety of purposes. They can be more long-term financing because it's a negotiation, right? You're negotiating just with a private individual. Some private individuals and private lenders I know like long-term deals. They just want to put their money out and collect a check. So rental properties can be really good for private lenders. And you can use it to fund a down payment on a traditional mortgage, where traditionally the hard money loans, they don't like funding the down payment on a traditional mortgage. Where private lenders, I've seen it done. There's a lot of different things you can do with both types of loans, but really the one big differential in those two is a private lender in a private loan is going to be a little bit more flexible than a hard money institutional loan. So institutional loans typically have lending, criteria that they want to lend in. A private lender is going to lend based on a relationship. They're going to lend based on a deal that they like, and that can change based on the relationship changing. Let's move on and talk a little bit about interest rates and the fees. Hard money loans tend to have higher interest rates, there's no question, and higher fees and fees upon fees compared to private money loans. Now, this isn't always the case, but let's just look at a hard money loan. They're typically considered higher risk due to their short-term nature. And a lot of times, those hard money loans, remember it's Wall Street money, so they want to get paid up front. So a lot of times a hard money lender or a hard money loan will have points up front. So even if it's short-term, they know they're only going to get interest for a short period of time. They want some type of points or some type of money up front. This is very common in hard money loans. Now, private loans, especially the ones I see a lot on Private Money Club, usually it's just an interest rate. Some charge, some private lenders will charge points, but some do not. Some have built relationships with borrowers, therefore they just waive the points. So therefore, hard money loans are viewed as a riskier type of loan than a private money loan because of their short-term nature. And another thing that I see a lot of hard money loans do, and now I'm starting to see a lot of private money do this, but is fix and flip projects, commonly known as flips. So these are definitely higher risk because they do go south sometimes. So short-term nature falls in with that fix and flip. Rentals typically carry a little bit lower risk because obviously you got the rent roll to support it. Let's move on. Let's talk about the approval process. Hard money lenders are more lenient in their underwriting standards in some cases, compared to traditional lenders, that is. Private money lenders, they may even be more flexible. So a private money lender is so based on a relationship that really there might not be a whole bunch of background because you know the person. You've built a relationship. If you're brand new with a private lender and a hard money lender, they might be very similar in terms of like all the stuff you have to do to get your deal underwritten. But as you keep doing more and more deals, the private money lenders definitely going to be more flexible. I know this to be true, and I do this. I lend to the same people over and over, and I definitely am more flexible with the people that I lend to. This makes it a lot easier for the borrowers to secure private money loans because they've got that relationship. Hard money lenders, sometimes it seems like every deal you do is starting right at the beginning. It's kind of like bank loans. Every deal you do at a bank, it's like, oh, here we go again. You almost have to systematize the whole thing. It also means one thing, though. Borrowers should be really careful to thoroughly understand the terms of the loan and the potential risks involved. Like, this is important. A lot of people get into these loans and they don't know the risks. They just need the money and they don't read the documents. They don't know what they're giving up and they don't even know how the money's going to be paid. So a lot of times, like, the deal will close in a hard money loan, the borrower didn't read the terms and they don't get all the money that they need because some of it's held back. The rehab's typically held back in draws. Private lenders, well, sometimes there's draws and other times, because of the relationship, there's not. So the fifth thing I want to talk about is the repayment terms. So hard money loans, remember, they have shorter repayment terms compared to a private money loan, which might be longer if it's a rental or something. So what that means is the private loan can actually be more expensive in the long run because you're paying interest for a longer period of time. Private money loans may also have longer repayment terms. Even though they're more flexible on the repayment schedules, you can sometimes go a little bit longer out. Now, I will say, in recent years, hard money lenders have definitely kind of been blurring over into the rentals. But in the old day, they really didn't like those long-term loans. But we do see some hard money lenders doing loans that are longer in duration, like the rentals. They'll go 5 years or 10 years. And sometimes, I've even seen them 20 years. Private money lenders, it can be just about anything. It can be longer repayments, more flexible terms, flexible repayment schedules. Really, you're just dealing with somebody and you're negotiating with them and building a relationship. So it just makes logical sense that it's easier to deal with private lenders than to deal with hard money lenders, which are more than less institutions. Hard money loans are acquired through hard assets, with real estate being the most common one that I see. The loan amount and the rate is decided by the value of the asset, the experience of the borrower, and so on. Private money is lent by individuals, maybe organizations, trusts, self-directed IRAs, IBC policies, and so on. And the terms can vary greatly. From lender to lender, the terms are always going to be different. Both hard money and private lenders offer quick approval times, which is why a lot of people use them. They need to close fast, and both can. They can close incredibly fast. So traditional financing, like a bank, they can't close fast. They have their process and procedure, and it's slow. And a lot of times, private money loans, sometimes hard money loans, they're not really going to put you under the microscope. So hard money loans and private money loans, a lot of times, there's not really a credit check required. Now, some do, some don't. But again, it varies. The liquidity for investors is what they need. They need the money and they need it fast. So more flexibility means more options for the borrowers and more money for the lenders. Private lenders might not be as experienced either. They're definitely not as heavily regulated as a hard money lender because, again, a hard money lender is typically an institution. However, they often have lower interest rates if you have an existing relationship with them, and that allows for the trustworthiness between either party to become a very vital piece of the investment deal. Hard money loans provide more security than private money loans due to their licensing requirements. So hard money lenders typically have licensing, and they're usually a mortgage broker by all intents and purposes. Therefore, it might be a better option for a first-time investor who has a lack of experience in real estate to go with a hard money lender. It's going to cost them more, but because of the stringent underwriting and because of the willingness for a hard money lender to look at somebody that maybe is a first-time investor, I think that's sometimes the best choice. Me as a private lender, I won't lend to somebody that's brand spanking new. There's just too much risk in it for me. And I want protection against potential losses, where hard money lenders can maybe absorb a little bit more of that risk, or they just charge a lot more in interest. And for me, that's just not a risk I'm looking to get into. So you can see, we sort of just talked about two different types of lenders, hard money lenders and private money lenders. A lot of people blur the lines, and there is a lot of similarities. So there's makes perfect sense as to why you might do that. But when you're really getting into it, you need to understand the difference. And if you like the private money lenders, then check out privatemoneyclub.com. That's definitely the source for individual private lenders. And that's where you're going to build the relationships. It's the dating site for money. So give it a whirl, check it out, and we'll see you on the inside, because that's where I lend all my money. But with that being said, folks, I hope you enjoyed this. And if you did, make sure you subscribe to this channel and click that little bell. Smash that bell so that you're notified every time I put a new video up. And why not do one more video? So check this one out. Where should I use my infinite banking policy? Folks, go out there, be your own bank, and get started. Thanks for joining me. We'll see you next time.